As of this moment, Upstart Holdings Inc., trading under the ticker symbol UPST, is priced at $63.31, marking an intraday gain of over 1.80%. On the surface, this appears to be a solid day for a notoriously volatile stock, a green arrow that might reassure the hopeful investor. But the reality of that number is far more complex than a simple daily uptick. This isn't just a fintech company having a good day. It's a battleground stock fighting a war on multiple fronts. And today's gain is merely a momentary truce in a much larger conflict. The expectation sold to the market is that of a revolutionary AI powerhouse, a company that has cracked the code on lending and is set to disrupt the archaic FICO-based system forever. The reality, however, is that Upstart is deeply, almost painfully, tethered to the unforgiving mechanics of the credit markets and the macroeconomic whims of the Federal Reserve. Its AI may be forward-looking, but its stock price is chained to the present-day realities of interest rates and capital availability, creating a chasm between its technological promise and its financial performance that has trapped many investors. Many who have added Upstart stock to their portfolios, perhaps through platforms like Robinhood or SoFi Invest, were captivated by a powerful and elegant narrative. The story was simple. Traditional credit scoring is broken, leaving millions of credit-worthy individuals out in the cold while exposing lenders to unnecessary risk. Upstart, with its sophisticated artificial intelligence models, promised a better way. It claimed to peer deeper into a borrower's true risk profile, unlocking affordable credit for more people while simultaneously delivering lower default rates for its partner banks. For a time, this narrative held firm, fueling a spectacular rise that made it a darling of the growth investing community. However, the deeper, more challenging reality is that Upstart is not the master of its own destiny. Its AI is only one part of a complex equation. The other, far more dominant variables are the cost of capital and the risk appetite of its lending partners. When interest rates rise, the entire lending ecosystem seizes up. The demand for loans cools, and the institutional capital that buys these loans dries up, leaving Upstart's brilliant AI with nowhere to deploy its insights. This fundamental dependency is the contrarian take that so many have had to learn the hard way, transforming what looked like a pure technology play into a highly cyclical financial stock, subject to the violent swings of a market it does not control. Examining the recent trading activity reveals this tension in sharp detail. Today's upward movement is welcome, but it comes on the heels of a brutal month where the stock saw significant downturns. Trading volumes have been erratic. On days with broad market optimism or a slight dip in Treasury yields, we see surges in buying volume as traders speculate on a pivot, while on days with hawkish Fed commentary or inflation fears, the selling pressure is immense. This isn't the steady accumulation you'd see in a stable, mature company. This is the frantic, high-stakes betting of a stock that could either double or halve on the next major economic data release. Institutional investors, whose activity can be tracked through filings with Fidelity and Interactive brokers, appear just as divided. While some large funds may be holding a core position, betting on the long-term disruption thesis, the options market activity tells a story of intense short-term hedging and speculation. There is a palpable lack of consensus among the so-called smart money, which should be a clear signal to any retail investor considering a position. The reaction to its last earnings report was a microcosm of this entire dynamic. Even if the company meets or slightly beats expectations, the stock's direction is ultimately dictated by the forward-looking guidance, which is inextricably linked to the macroeconomic outlook. This makes traditional self-investing based on company fundamentals incredibly challenging. It's less about analyzing Upstart's performance and more about successfully predicting the future of the entire U.S. economy, a task that has humbled even the most seasoned analysts. When you invest online in a stock like Upstart, you aren't just buying a piece of a company. You are taking a highly leveraged position on the future of interest rates and consumer credit.
So, what exactly does Upstart do? It's crucial to understand that Upstart is not a bank. It does not lend its own money. For the most part, instead, it operates as a platform, a sophisticated middleman. Its core business model involves partnering with banks and credit unions. These partners use Upstart's AI-powered platform to originate personal and more recently auto loans. For each loan that is originated through its platform, Upstart collects a fee from the partner bank. This fee-based model was initially seen as a major advantage, suggesting an asset-light, high-margin business. The expectation was that Upstart could scale rapidly without having to hold the credit risk on its own balance sheet. However, reality bit hard when the capital markets tightened. The primary purchasers of these loans, large institutional investors, pulled back, forcing Upstart's bank partners to become more cautious. In a move that spooked the market, Upstart even began using its own balance sheet to hold some of the loans, blurring the lines of its supposedly capital-light model, and exposing itself directly to the credit risk it was supposed to offload. This was a critical moment where the pristine narrative of a pure tech platform collided with the messy reality of being a participant in the lending market. Its business is a three-legged stool. The AI model must be effective, its bank partners must be willing to lend, and the secondary market must be willing to buy the loans. If any one of those legs wobbles, the entire structure is compromised. Looking back at its history provides essential context. The period following its IPO was one of near euphoria. The stock soared to astronomical heights as it consistently reported triple-digit revenue growth in a low-interest rate environment. The market was pricing it not as a financial services company, but as a revolutionary software-as-a-service company, and the expectation was for a limitless addressable market and flawless execution. The subsequent collapse of the stock was a brutal but necessary correction, a painful lesson in market gravity. It demonstrated that Upstart's growth was not entirely secular. It was heavily subsidized by a period of unprecedentedly cheap money. The old reports from that era speak of unbridled optimism, but they are now a testament to how quickly a market narrative can fall apart when the underlying economic conditions shift. This is where many investors can benefit from more structured investment help or even consider diversified solutions like Schwab Intelligent Portfolios to mitigate single-stock risk, especially with a name as volatile as this. The journey of the Upstart stock is a classic case study in the tension between a powerful story and a complex reality. Now, let's turn to the future outlook, where the divergence between scenarios is wider than ever. The bullish case, the expectation that keeps long-term investors holding on, is predicated on a few key catalysts. First and foremost is a shift in the interest rate environment. If the Federal Reserve begins a cycle of cutting rates, the entire lending landscape would transform overnight. Capital would flow back into the market, demand for loans would increase, and Upstart's platform would see a dramatic resurgence. Second, the continual expansion into the auto loan market represents a massive opportunity. This market is significantly larger than the personal loan space, and if Upstart's AI can prove its effectiveness here, it could unlock a new and substantial revenue stream. Finally, the acquisition of new bank and credit union partners is a critical metric to watch. Every new partner validates the platform and expands its reach, slowly building a more resilient and diversified ecosystem. These are the catalysts that bulls believe could propel the stock back towards its former glory. However, the reality is shadowed by significant and undeniable risks. The most immediate risk is that interest rates remain higher for longer, or that the economy tips into a significant recession. In a recessionary environment, loan defaults would inevitably rise across the board. This would be the ultimate test for Upstart's AI models. If its loans default at a rate significantly lower than the FICO-based alternatives, its value proposition would be proven beyond a doubt. But if its default rates spike to levels comparable to or worse than traditional models, the very core of the company's narrative would be shattered. This is the existential risk that hangs over the stock. Furthermore, the company faces increasing competition from other fintech players and even incumbent financial institutions that are developing their own AI lending capabilities. Relying on a concentrated number of bank partners and institutional loan buyers also remains a key vulnerability. What do you think is the biggest hurdle for the Nvidia stock of the lending world, Upstart, to overcome? Comment below whether you believe it's stubborn inflation and interest rates or the looming threat of rising loan defaults in a weak economy. This is a critical question for anyone analyzing the company's future. In summary, the story of Upstart Holdings is a compelling, high-stakes drama of innovation versus incumbency and technology versus macroeconomics. The expectation was that of a smooth, software-driven disruption of the lending industry. The reality has been a turbulent, cyclical ride dictated by forces far beyond its corporate headquarters. The AI technology is genuinely impressive, and its mission to improve access to credit is a powerful one. However, its stock